Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome back to the InvesTips podcast. Today, we're going to discuss about one of the key building blocks for any resilient portfolio, namely bonds. We'll explore the basics, see why they're so important for one's balanced financial journey, and discuss practical ways to include bonds in a portfolio. Joining me for today's podcast is Manpreet Gill, Chief Investment Officer for Africa, the Middle East and Europe, based in Dubai. Welcome, Manpreet. It's really great to have you as always.
Thanks, Steve, for having me. Quite excited about our chat on bonds today. Asset class that's familiar to so many investors, but even experienced investors often haven't explored all the details.
Okay, absolutely. I think let's start with the fact that bonds really are for everyone. So whether you're just starting out on your investment journey or whether you're approaching retirement, I think they can be a really steady anchor in your portfolio. So bonds, I look at them as the cornerstone of balanced investing, providing steady, predictable income, tempering volatility, and lending greater resilience to a portfolio. So maybe to set the stage for our conversation, could you just walk us through the basics? What bonds actually are and how they work?
Sure, Steve. So bonds are fixed income investments that can be issued by a variety of organizations. They could be governments, municipalities, or companies, and they do this to raise capital for projects or operations. Now, as an investor, when you invest in a bond, the bond issuer pays periodic interest payments, which tend to usually be annually or semi-annual, and at maturity, you receive full payment of the principal. Now, there are a few sort of foundational elements worth understanding here related to these concepts. So a bond's face value is the amount the issuer prepays at maturity. If the market price matches the face value, the bond is said to be trading at par. And of course, when the market price is slightly below face value, is said to be trading at a discount, and vice versa, is said to be trading at a premium. Now, coupon rate is the interest rate the bond issuer pays to the investor, and it's expressed as a percentage of the bond's face value. Term refers to the fixed length of time a bond remains active. Maturity is the specific date at which a bond's term ends and the issuer repays the principal. Current yield measures a bond's annual return relative to its prevalent market price. And related to that, yield to maturity estimates the total return generated on a bond if it is held to maturity. Now, yield to maturity measures incorporates both coupon payments and the capital gain or loss by maturity, which really makes it the most comprehensive measure of a bond's total return. And finally, a credit rating reflects an issuer's ability to meet its debt obligations. Usually, but not always, government bonds tend to receive much higher ratings, such as AAA or AA in developed market bonds, which indicates a low risk of default, while lower ratings such as single B or triple C suggest a much higher risk of default, which is often more common among high yield or what are often referred to as junk bonds. Now, there are many types of bonds out there with quite a wide range of risk return profiles. Conservative investors might stick to more higher quality bonds, government or investment grade rated bonds, while more seasoned and experienced investors who understand market dynamics, understand the risks, could consider a greater mix of high risk but high yielding bonds instead.
Okay, thanks, Manpreet. I guess the advice about not taking unnecessary risks, I think, resonates with many. I always tell clients that if an investment keeps you up at night, it's probably not the right fit for your portfolio. Peace of mind is really as important as returns are or expected returns are. Maybe if we can sort of start looking at some of the key drivers of bond markets next. So we know that bond markets are quite different from other financial markets owing to their structure, participants, and sensitivity to macroeconomic factors. So maybe can you share your perspective on the most important drivers and how they influence returns?
Sure, I think there are a few worth being aware of. So I'll start with interest rates because these tend to be one primary factor driving bond returns. Now, central banks play a big role here when they tend to change the benchmark rate or adjust government borrowing. This tends to have a significant impact on the bond market. So, for example, if a central bank raises interest rates, borrowing becomes more expensive and bond prices usually drop. And the inverse is also true when interest rates are cut. So this type of return we tend to refer to as interest rate risk. Now, second sort of factor to be aware of is credit risk. This measures the potential for default and usually tries to gauge the possibility that a bond issuer might be unable to pay either the interest or the principal. One can, of course, reduce this risk by choosing higher quality bonds, but the trade off is lower returns. Now, reinvestment risk is the chance that you may have to reinvest the maturity amount at a lower interest rate than the original investment. And I think that's something always, maybe a factor that we don't consider often enough. When you hold bonds over the long term, the exposure is often to a combination of interest rate and credit risk, both of which increase as the time period gets longer. Now, to compensate for this risk, you'd expect higher yields for longer maturity bonds, and this is referred to as the term premium. And typically, longer maturity bonds have, offer a high yield or a term premium over shorter maturity bonds. Liquidity is another factor that can differ across bond types and influence the bond price, yield, or risk profile. So, for example, government bonds tend to be highly liquid, which translates into more stable prices and a lower liquidity premium. And finally, inflation expectations can also play a key role in shaping bond market returns. So, when inflation is expected to rise, one would expect interest rates to be higher, which in turn pushes down the price of existing bonds. And a related point here is that one way to manage disinflation risk especially is to consider inflation-linked bonds, which are another subcategory which can help adjust payments in line with inflation.
Okay, that's clear. Maybe it's worth now just digging into a little bit more complexity when it comes to bonds, right? So I think a lot of people have heard the terms such as yield curve and duration being thrown about. I think these are obviously very important for two reasons. One is to understand where we might be in the economic cycle, where interest rates might be heading, etc. But also thinking about how interest rate movements might affect the short-term performance of your investments or bond investments. So maybe can you give us a sense of what a yield curve is and key factors there, and then talk a little bit about duration as well?
Sure. So I think, as you mentioned, maybe we should first start with understanding what a yield curve is. So a yield curve is nothing more than plotting the yields of bonds with the same credit rating, often the same issuer, but across the range of maturities. So, for example, from a few months all the way out to 10, 20, or 30 years. So that sort of becomes an illustration of how interest rates or yields vary across different maturities, again, ranging from a few months to many, many years. Now, the shape of the yield curve, as you mentioned, particularly of government bonds, can often be one signal of the potential future direction of interest rates and a signal of where we are in the economic cycle, whether it's expanding or contracting, and might become easier to understand if we consider four particular types of yield curve shapes. Now, a normal yield curve is one where investors tend to be confident of steady economic growth and expect interest rates to gradually rise. So, normal is usually upward sloping, where longer maturity bonds offer a higher yield than shorter maturity bonds. A second type is a steep yield curve. This is where the gap between long and short maturity bonds starts to widen. This often can be a signal of robust economic growth. A third type is a flat yield curve, where there's not much of a gap between long and short maturity bonds. This can signal economic uncertainty or potentially, tell us we're in a period of transition between growth and contraction. And finally, there's the inverted yield curve, which can be, somewhat counterintuitive. It's where long maturity bonds yield you less than short maturity bonds. This can sometimes be a lead indicator of a potential economic slowdown or recession. Now, we often pay a lot of attention to yield curves because they have done a fairly good job of predicting recessions historically. And it can hint at potential shifts in the economic cycle. But we should remember that no signal is perfect, no matter how strong a record it might have. Now, Steve, you mentioned duration, and I think duration is an important related concept because it's more a technical term, a jargon used to describe the sensitivity of bond prices to changes in interest rates. So if you have a longer maturity bond, for example, they tend to have a higher duration, or in other words, higher sensitivity to changes in interest rates compared to a short maturity bond. So that's really where this whole discussion of a yield curve can become important for investors.
Okay, so maybe just to clarify on one point, so duration and maturity, they sound like similar concepts, but they actually measure different things, right? So while maturity tells you how long until a bond pays your money back, duration is more about how sensitive that bond is to interest rates. So it's used more for managing short-term price risk rather than the maturity profile per se. Okay, so maybe we covered some of the key concepts and drivers. So, do you think everybody should consider investing in bonds?
Well, I'd rarely say everyone, but I think for most investment portfolios, it's definitely worth considering investing some amount of bonds as a mix of a multi-asset portfolio. Uh, the reality is, look, bonds end up playing a few key roles, right? So first off, I'd say that bonds can provide fixed and regular interest payments, which can be a predictable and reliable income source if that's important to you. Now, if you're someone who does indeed need that regular and stable cash flow, bonds can be ideal. For example, if you're in retirement and looking for an income, payments come at regular intervals, so you know your cash flow well in advance, allowing you to plan and budget more easily. But bonds are also a great way to help protect and even grow your savings. So, research from one of the investment management firms we took a look at found that over about a 40 to 45-year period, short term corporate bonds provided positive returns in almost every year, except, of course, for big events like the global financial crisis or the inflation spike of 2022. What this shows us is that high quality government or long term bonds can help keep your money safe, but even short term corporate bonds can help support you along such a journey. And finally, in a multi asset portfolio, bonds are a great way to help balance out wild swings in the stock market. Generally speaking, and there are exceptions here, bonds don't move in sync with stocks, and also have lower drawdown risk. So those two characteristics can mean they can really help at diversifying your investments and making your portfolio a little more resilient.
Okay, I think a lot of people talk about equity markets and the equity market bull markets that we've seen, and how much if you compounded your returns just purely in equities, how that would look. And usually those are based on US equities because we have a longer history there and the data looks a lot better, to be honest. But maybe can you walk us through how bonds have performed over the years, and what, probably as importantly, how they've held up during tough market conditions?
Absolutely. I think that's it. It's good to sort of look at the parallel of how bonds perform over long periods of time. Um, so let's consider maybe investments made during a bond bull market phase. So, for example, if you'd invested, let's say, $1,000 in US government bonds in 1981, that would have grown to a total of over 19,000 US dollars by 2021. If you invested the same $1,000 with riskier bonds rated BAA, that sum would have grown to about 47,000 US dollars. So that does illustrate that bonds also have the potential to help build long-term wealth. But I will say that, like a lot of other public financial asset classes, bonds do face times of turbulence. So if you go back to 1994, we had what's somewhat awkwardly called the Great Bond Massacre, when bond prices did take a big hit, and over $1.5 trillion in value was wiped out in bond markets. Really resulted from a sharp spike in bond yields. But fortunately for investors, that normalized quite shortly thereafter by mid 1995, after the Fed stepped in measures to calm financial markets. So that's perhaps one example of where bonds can, while they can really help preserve value, they can face periods of volatility. Now, in 2008, during the global financial crisis and later during US China trade tensions, bond markets again witnessed some amount of volatility. But I think the key here is, unlike riskier asset classes, what's really key is how quickly they tend to bounce back, in many cases faster than stock markets. And this is often because of strong support from governments and central banks, which tend to introduce calming measures in bond markets. So, bigger picture takeaway is that bond markets are generally fairly resilient, and during periods of volatility, its high quality bonds can really help preserve capital and provide reliable income.
Okay, so I think we've explored why bonds are so important. Obviously, any investment strategy needs to align with people's personal objectives and, importantly, risk appetite, right? So, maybe as we come to a close, Manpreet, you could just give people a few key things that investors should keep in mind when investing in bonds.
Sure, and maybe what might be helpful here is a quick mental checklist. First, when considering a bond, first off, I'd consider how financially strong the issuer is, and hence what confidence can you have that they can pay you back. Second is, consider how long the bond's maturity is, because a longer maturity to, period to maturity means your money is tied up for longer. Third is really sort of consider how much risk you're taking on. Riskier bonds might pay a higher yield, but obviously they come with often a greater chance of default or higher sensitivity to interest rates. And finally, and I suppose this goes a little beyond bonds, is always make sure you have enough liquidity handy so that you're not forced to sell bonds at a particularly bad time.
Yeah, and that's so true across asset classes. Well, thank you, Manpreet, for taking us through your thoughts today. I guess the way I look at this, when markets are unpredictable, bonds can be really, really important and can help mitigate portfolio volatility and help calm your emotions. And obviously, we always talk about how investing is as much managing your emotions as anything else. So they bring a balance to your portfolio, offering a steady stream of income and help protect your capital when things get rough out there. So, with that, I'd like to thank the listeners for joining us today. Thank you so much for joining us. It's been a real pleasure to go through this with you. I hope you found the discussion insightful. If you'd like to know more about bonds, please go to the link in the podcast description, and we will speak to you again soon. Until then, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.